As we leave behind a week that's been dominated by interest rate cuts with 50 basis points from the BOC, from the SMB, and 25 from the ECB, you might think that this is going to be a period that calms down in the lead up to the Christmas period. Well, in fact, we see quite the opposite. We're going to see more rate decisions, and this time around, it's not going to be as clear cut as we have seen. Certainly, when it comes to the Federal Reserve, people are growing increasingly confident in a rate cut there. But we've also got the Bank of England. We've also got the BoJ. And so the potential for rate cuts or even hikes this time around, but also the projection of where we are going from here is going to be really key as we move into perhaps the busiest week for the remainder of 2024. So let's get into it. So here is the breakdown in terms of the big ticket items according to Trading Economics. And quite frankly, I couldn't fit them all into one screen. So I've ended up trimming a little bit here, a little bit there. But ultimately, the big ticket items are here. Look, Monday really will kick off with a big focus on China, of course, coming at a time where we have grown more optimistic about stimulus from China in the year ahead, but also fearful around what might happen with the breakdown of trade relations with the US. Well, industrial production, retail sales going to be really key as we kick things off for the new week. Then, of course, we start to move into the realms of the PMIs. And certainly, if you're looking over the course of Monday, you're going to be looking at French, German, Eurozone, UK, US, all that good stuff. Big PMI releases coming out over the course of the day. So often when we're talking about Mondays, they're relatively quiet. This Monday is anything but, and those PMI figures are really going to give us a good gauge of the direction of travel for some of these key economies. Moving into Tuesday, we've got the jobs report out of the UK. We've got inflation data coming out of Canada, retail sales from the US. And then Wednesday, inflation from the UK, and then wrapping it up at the back end of the day with the FOMC interest rate decision. So a huge amount of interest on Wednesday in particular. And then moving into Thursday, we've got the BoJ happening overnight, and then the Bank of England interest rate decision and the Japanese inflation rate. So between those 2 days, you know, you've got like UK inflation, Federal Reserve, BoJ rate decision, Bank of England rate decision, Japanese inflation. It's actually ridiculous. And you're wrapping up the week on Friday with the retail sales and the core PCE price index out of the US. So a massive week, quite frankly, and a huge amount for traders to really get through. Now, I will provide the basis for a sort of bigger video to get into sort of the nuts and bolts of some of these releases. The likes of the UK inflation report, the likes of the Bank of England, the Federal Reserve, the core PCE price index. Because generally when I'm trying to cover 3 different topics in one video, it just goes on for far too long. So this is going to be a sort of overview of those items. And then if you want to see a sort of deep dive in terms of exactly what we expect from these numbers, from these announcements, what we could potentially see in terms of market movements, keep an eye out on the channel for that, because I'll try and sort of do these deep dives as well. It's going to give you a lot more in-depth information on them. Nonetheless, let's sort of kick off with the first area of interest, and that is the US. Now, the US, of course, we have gone through a period where we thought that the back end of the year was going to be dominated by 50 basis point cuts in November, 50 basis point cut in December. That certainly isn't what happened. Nonetheless, we have seen a bit of a shift recently towards greater confidence that we see a rate cut in December. So that's something. But also the trajectory of rates over the course of the next year has changed. So part of it came down to Donald Trump coming into power. Part of it's coming down to inflation sort of showing its head once again in the US and the UK. And so, you know, with a stronger outlook for the economy under the view that Donald Trump's going to be coming in with stimulus measures of his own and enacting pro-growth strategies, and the possibility that that could cause higher inflation alongside the tariffs that he's potentially going to impose, that has quelled some of the bullish sentiment for rates to come down over in the US. And certainly we've seen a significant adjustment in terms of those expectations. And so this meeting will be key for that, right? I mean, I think we've gotten to a point where pretty much markets expect a 25 basis point cut. So that's probably going to happen. But beside that, is the outlook over the course of the next year. What's the pace of easing? I think at the moment markets are just pricing in a single rate cut in the first quarter. So are we just going to see a rate cut every quarter? Bear in mind, there's 2 meetings within that. So maybe it's like just a rate cut every other meeting. And so, it's quicker pace in certain quarters and slower in others. So that's going to be key, really, is trying to understand exactly what the outlook is. And key to it as well is, as you see on Wednesday, FOMC economic projections. It means we're going to see what their outlook is in terms of inflation, in terms of growth, and in terms of the dot plot. So a view on where rates are going from here. So that's what makes this a particularly interesting Fed meeting. Now, in terms of what else we've got going on, we've got the core PCE price index. So inflation out of the US expected to move higher, 2.9 on the year-on-year figure. That's off the back of another 0.3 number for the core PCE price index. Again, like I said, I'll go into a sort of deeper dive when I produce the separate video for this, but certainly we have seen a resurgence in terms of price pressures. And so what we could quite easily see is a Fed meeting that says one thing, but 2 days later, we see the core PCE price index coming out and pushing expectations in another direction. So we need to see those inflation pressures ease, but we're seeing Federal Reserve cutting interest rates and people becoming more bullish about the economy under Donald Trump. So, you've got the push and the pull of different factors, but certainly the Fed want inflation to move lower, but some of the actions of the Fed and some of the likely actions of Donald Trump are probably not going to do exactly that. Aside from that, Monday PMIs, Tuesday retail sales, industrial production, and Thursday we've got that final GDP figure to look out for. So a massive week. In terms of expectations, as I said, really we've seen a convergence towards that 25 basis point cut, which now is, in the sort of 90 something percent expectations. So market's really very confident that we will see exactly that. But what we're going to see for this meeting is, how are things when we look further out in terms of expectations? And so the dot plot's going to tell us a lot about that. Certainly, for many of these central banks, there's a view that we're going to see rates cut by around about 100 basis points over the course of the next year. Is that where they stand? How are they feeling? And there's always this sort of view of data dependency, and I'm sure they will push that narrative once again, because ultimately you don't know what's going to happen, especially the US. There's a lot of uncertainty. Are we going to see a resurgence in terms of inflation? So they need to be data dependent, because if we see a major surge in inflation, they're going to have to take their foot off the gas when it comes to easing. So let's just jump onto the charts. This is the chart for the Russell 2000, not necessarily one that people trade as much as, say, the likes of the S&P, the Dow Jones Industrial Average, the NASDAQ. But nonetheless, I thought an interesting one, because this is heavily influenced by rates, because higher rates are not necessarily a good thing for companies within this index, because many of them are not profit making. It means they're loss making. So when you're loss making, you need to raise funds from somewhere, right? You need to get money to be able to continue to build. And generally that's coming from either issuing new shares, not great because you're diluting the current shareholder base, or else taking on funding from elsewhere and borrowing money, right? And so the cost of borrowing rises as we see the Federal Reserve hold off on interest rate cuts. So rate cuts were supposed to be good for the small caps, and certainly coming into the election, there was a view that this coming year is going to be great for small caps. And what happened was Donald Trump came in. The expectations around rates did shift against what you would think is beneficial for the Russell 2000, but instead people focus more heavily on the fact that he's very much centered on giving sort of US businesses and US located or domiciled businesses an upper hand with his policies. So that could benefit the small caps that might not necessarily be international in nature. And so they have managed to gain ground, but we're seeing it coming under pressure at the moment. You can see that on a weekly time frame here, but the daily time frame tells you a similar kind of story. But we've got a very clear-cut uptrend over the course of 2024 and sort of the back end of 2023. So as we head lower, what's going to be really interesting here is, are we going to view this as a sort of retracement before we head higher once again? Are we rolling over here? I don't necessarily see the basis for this to top out, right? I mean, certainly if you're looking at this from the perspective of, let's go Russell 2000 against the SPX, right? So if you're looking at it as a relationship against the S&P 500, if we go out to the monthly time frame, you can see this massive deterioration over the years shows that the huge outperformance for the S&P 500 against small caps, right? So we're coming back into extreme areas here when it comes to the undervaluation of small caps against the big caps, or the S&P 500. That points towards potentially the S&P 500 turning a corner and outperforming at some point, yes, but also a view from many that the Russell 2000 is undervalued and is worthy of allocating funds into. The question mark is, are we going to see that slow pace of easing? Maybe it's a bit slower, but certainly if we see a strong US economy with beneficial policies for businesses within the Russell 2000, and we do see rate cuts, well, that should ultimately be beneficial for the Russell 2000. So we're pulling back. If we do see this rate cut, which is what markets are expecting, there's a good chance that we do see some bullish price action coming in. But given the fact that you're seeing a near enough 100% expectation that we see a rate cut this time around, it's probably not the rate cut that's going to be doing the moving when it comes to the volatility around this announcement. Instead, it's probably going to be maybe projections, the dot plot, things like that will have a tangible impact on sentiment for markets. And so, maybe we see further downside, but look out for this area of support, right? So we've got this sort of trend line support confluence with the 76.4, and it depends how long we sort of consolidate around here, but 76.4 fib, there's a good chance that if we see further downside, that's going to form a nice area of support for the bulls to potentially come back in. It's a 2327, but we're near enough at the 61.8 as well. So, if we were to break through this 2284, then it would negate the trend of lower lows, but also break through this prospective trend line support. So I don't think that's going to happen personally. So this is the key sort of line in the sand for me, 2284. And as we head lower, for me, I think the bulls are going to come back into place soon enough. But certainly the sentiment, the outlook, the projections from this meeting will be really key when we're looking at the Russell 2000. Next up, let's take a look at the UK. And again, I was talking about at the top end of the show about the fact that I've been struggling to squeeze in some of these data points. I'm having to trim things left, right, and center here because there's a huge amount going on in the UK, just as there is in the US, right? So the US, you've got, say, core PCE price index, retail sales, the rate decision, and PMIs. Here we've got PMIs, the jobs report, the inflation report, the Bank of England, and then retail sales. Every single day has got big data out of the UK. Now, this comes off the back, interestingly enough, of the latest UK GDP number, and that came in at minus 0.1, which replicated what we had seen for the prior month as well. But certainly, minus 0.1, expectation was that we were going to see it actually come in positive at 0.1. So a couple of negative readings in a row now certainly tells a different story to what markets are maybe perceiving for the UK, which is, things have been looking pretty decent. Certainly when you're looking at, say, the PMI is looking pretty decent. And then we've been seeing this sort of uptick in terms of UK inflation, which certainly sort of grabbed my attention last time around, which is going to be really interesting when it comes to this month. And certainly if we're looking at, say, UK CPI, well, I'm just going to grab it up. From my memory, I think it was, I think it was 0.6 on the monthly inflation. So here we go. So yeah, 0.6 on a monthly. So 1 month alone at 0.6. That is trouble when you want to try and get back down to 2%, right? 0.6, it only takes a few months of that, and you've pretty much used all your wiggle room up. So how things play out over the course of this inflation report is going to be absolutely crucial. The expectation, as we can see here, in terms of the month-on-month number, is a negative minus 0.2. So that could really turn the tide, right? If markets have been seeing a sort of slower pace of easing from the Bank of England because of that number that we'd seen, that 0.6, we could see things really shift. And you can see the same kind of thing here, right? The core number expected minus 0.2. So if we see two minus 0.2s, suddenly we potentially start to see some weakness in terms of the pound. And if we're looking at, say, the Bank of England interest rate decision, okay, we're seeing a rate pause this time around, but what's the trajectory going forward? Are we going to see that shift if we see inflation shifting as well? Well, here's the view: 85% chance currently predicted that, or 86% chance that we see a rate pause. And then we're looking out to February, 67% chance of a rate cut. And then from there on, we're looking at a slower pace because it's going to take a meeting in May to potentially get another rate cut. So the pace of easing at the Bank of England is certainly very different to what we see for the likes of the ECB. And that's why I wanted to show you the euro against the pound. Now, bear in mind, this is one that we've been talking about very successfully, about this deterioration of euro sterling as we see the expectations around inflation and economic data in the Eurozone deteriorating, but the UK holding up better, despite the fact that the UK wants inflation to move lower. The stronger inflation picture alongside a relatively better performing economy does point towards this euro sterling weakness. But this big pop that we're seeing right now is a reflection of that weak GDP number. Now we come into a week that also could see this minus 0.2 on the inflation gauges. And if we see that, then we start to see the shifting narrative in terms of the pace of easing from the Bank of England, which could provide the basis for further upside for euro sterling, which is sort of rebounding against this prevailing trend. Nonetheless, short-term upside could be exactly that, unless we get told by charts that, that this trend is over. So the bearish trend does still continue. There is a good chance that if we see weak inflation data, then we could see further upside for this pair. But on the flip side of that, you could say that minus 0.2, we're setting quite a low bar, a high bar in some ways, in terms of being able to attain that. So there's a good chance that maybe we don't come in at that. Maybe we come in at minus 0.1, and so people think, oh, actually, it's stronger than expected. So that could actually ease that. So it's going to be a really interesting week, and certainly the perspective of the Bank of England and the outlook going forward, it looks like it's a given that they're going to keep rates on hold this time around. But certainly the perspective going forward is going to be really key, because the ECB is likely to continue to cut over the course of the coming meetings. And so the slow pace that's currently being priced in by markets does point towards the possibility of this rolling over once again. So a breakup through 83758 negates the bearish trend and points towards the bulls coming back into play. But until then, we're looking at the possibility that this is going to be not necessarily just a flash in the pan, because I think there is still a good chance we see further upside in the near term. But look out for how we respect or don't respect these Fibonacci levels. We're talking about 83188, which is the 61.8. And then if I can sort of zoom in to be able to see it well enough, 83406, which is your 76.4 fib. Those are going to be the really key lines in the sand for me as we're looking for at euro sterling heading into an absolutely critical week. And then finally, let's just wrap it up by talking about Japan. Now, Japan, again, it's another thing that I wanted to provide a preview for, so I'll try and do a standalone video for this as well. But certainly it's a really interesting one, because they are the outlier here, right? While everyone else is talking about cutting rates, they're either cutting rates or about to cut rates, the BoJ want to do the opposite, right? And what we had been seeing not long ago is people expecting to see a rate cut this time around, and now all of a sudden we're hearing sort of rumors coming out of the BoJ talking about a possibility that they hold off for this meeting. So this is a very live meeting when it comes to the possibility of action, but also the fact that the expectations sort of vary across the board does provide the basis for major volatility. Of course, we've got these PMI numbers coming out on Monday as well. Trade data on Tuesday, but really the big ticket item is on Thursday, and we'll follow it up with the core with the inflation data. But bear in mind, inflation data is important, but generally, as I've highlighted in the past, it's the Tokyo numbers that are the leading indicator, and generally their nationwide numbers should generally follow that same trajectory. So we might not necessarily see as much sort of volatility off the back of it unless we see a sort of outlier move. So you can see here markets expecting rates to remain steady this time around, and you can see expectations in the markets at 77% for no change. Well, you know, not long ago, people were starting to sort of warm to the idea that we were going to see a rate hike, 22% chance. So there is a good chance, but you can see January now perceived to be the base case scenario. I mean, only just about, it's about 45% for a pause, 55 for a hike. So the outlook from the BoJ is going to be really important as well. But certainly we are in a position where we could see the BoJ act. And so what's the Japanese yen doing off the back of that? Well, at the moment, we're really seeing domination by the US dollar when it comes to dollar yen, because we're seeing it coming back into strength in the wake of the sell-off that we saw back here in November. So you can see that initial pop, and then we started to see this rolling over, but we're seeing a rally back up into the 154. So bear in mind, this is the kind of area that we have seen action in the past from the BoJ. And so if the BoJ were willing to take action to try and prop up their currency in the past, you know, will the ascent of dollar yen force them into an earlier hike than you might see otherwise? Possibly, but certainly you would say that we've got a trend playing out as things stand with this near-term pattern of higher highs and higher lows. You've got the fact that we're coming into this sort of area of what you would say is sort of retracement territory if you were thinking we could potentially top out around this area, because of course we've seen a rally high, this lower low below this level. So are we retracing before we roll over, or are we just continuing on that upward trajectory that has been established through the back end of this year? Well, key to it really, I think, is going to be a view on how we're respecting these fib levels or not. And as you can see here right now, we're absolutely perfectly respecting that 61.8 Fibonacci level. And so, you know, if we were to roll over and then take out this support level down here at 151.79, then that starts to look like this rally is a retracement and that we're seeing it selling off once again with a view that we're going to see a rate hike soon enough from the BoJ at the time that the Federal Reserve are expecting to be cutting rates. Is that how it's going to play out? I say 151.79 is going to be that key line in the sand. Until we see that happen, you know, the pullback could be bought into once again. But certainly in a week that sees the likes of the Federal Reserve likely cutting rates, but also providing the basis for our outlook going forward for the year ahead, and the BoJ potentially hiking rates, but probably not according to market perceptions. Instead, it might have to be January that we see that move happen. You know, I think the dollar yen pair is really going to be a key one for traders to be following in the week ahead. I hope this has been useful. Like I said, I'm going to try and create as many of these videos as possible to sort of provide the deep dive into some of these key releases that we've got for this week ahead. This is a little insight into 3 of them. But certainly I'll try to provide you with even more as we head into a week that really is going to be absolutely critical for traders as we try to gauge whether we're in for another Santa rally. Of course, back end of the year, equity market's been doing very well. Will we see more of that? Let's try and look into that. I'll try and provide a video on that as well. We'll look into some of the data around Santa Rally. So thanks a lot for watching. My name's Josh Mahony, Chief Market Analyst at Scope Markets. Like, subscribe, follow. We're trying to grow the account. I hope you guys appreciate the content that I'm producing. Thanks a lot. And also looking forward to our end of year and festive break that we're all going to be having, which won't be too long, but I'll try and produce content as much as I can over that period as well. Thanks a lot, guys.